Good to have you with us. Thanks for tuning into Mirror Now. You're watching Investor's Guide. I'm Avni Raja, and this is the show where we guide you and help you on how you can make your money work for you. Now, over the next few episodes, including today, we're going to be talking about the various categories of equity mutual funds. Now, these constitute an important part of your portfolio, of your investment portfolio, and they really help you in terms of your long-term investment planning. So let's start first today by talking about what large cap funds are, how do they fit into your portfolio, and whether or not they make sense for you. And to do this, joining me is Feroze Azeez of Anand Rathi Wealth Management. Feroze, thank you so much for joining us on yet another episode of Investor's Guide. So let's start by talking about large cap funds because this is, of course, especially for new investors, people who are, getting into planning their financial portfolio for the first time. It's a very good place to start, really. So what can you tell us about this category?
Avni, like you rightly pointed out, this is a very important category because this is a beginner's category. As the name says, large cap fund. It invests in companies which are big in nature, which are not the tinier ones. These are companies which have established themselves, and they're generally the large companies of India, which implies the top 100 companies of the country, listed ones. So that's what is the universe which the fund manager invests the corpus collected into. Almost 80% of the money collected in a large cap fund, by design, by regulation, has to go into the top 100 listed companies of India. That's why it is considered lower on risk, and hence becomes a very good start point for a person to invest in a diversified fashion into top companies.
Okay, so when a fund manager is sort of, looking through these top 100 companies to sort of invest in, these are what is obviously, like we pointed out, called as large cap companies where these funds invest in. What are the kind of things they're really looking for before deciding to put money into this?
Yes, so Avni, the fund manager and his team or her team comprising of analysts, actually they go threadbare understanding each and every company in the top 100 and try and look for companies which have a very stable business, which has a business which is going to grow because of the nature of it, a good management, a good governance, and also good profitability and growing profitability. These are the few things which the fund manager sees to cherry pick the stocks, and also makes sure that it does not buy, or the fund manager does not buy, companies of the same nature. There is pharmaceutical companies which could form a part of large cap funds. There could also be IT companies, there could be automobile companies, there could be different kinds of companies from different business natures which are all brought together. So the fund manager sees businesses and also sees the sector which those businesses operate in to form a robust portfolio so that each of the constituents complement each other and gets you that performance which the long-term equity potential has for an investor.
Right. So what would you say would be the benefits of this particular category, investing in large cap funds? Because obviously they are for could be useful for a first time investor as well. So it would be okay for somebody who's not very happy to take too much of risk.
Avni, if I have to put some numbers in place, this category of fund is the least risk category. The risk which is measured in standard deviation, which is a risk measure, is 13 here. 13 is the risk number, but there could be other categories at 15, 18 standard deviation as well, 3-year standard deviation. So if I have to give you a numerical number, the risk number for this category is 13 approximately. But the other categories could be far more, like a small companies fund could be as much as 18. So that's one advantage, a lower risk. Second advantage is that the stocks which the fund manager buys are very liquid in nature. So when you ask for your money back and other investors take their money back from the fund's performance doesn't get impacted because of the pressure of investors wanting to take back money or put excessive money. So it is not impacted by liquidity crisis, one. and the other is if they are on lower risk, actually measured mathematically also.
Okay, and as far as one's investment horizon is concerned, I mean, we've constantly reiterated that equity investments need to be done for the long term to actually see good returns coming in. What should be the kind of investment horizon one should be looking at, and how should one place this in one's portfolio?
The time frames, Avni, are very important to ascertain the risk, because longer the time period, lesser is the risk. Can an investor invest for even 1 year? The answer is yes. But will he expect predictable returns? The answer is no. He can also lose capital, or as an investor, you can lose capital if you invest for 1 year and 2 years. So the optimal time frame to make sure that your capital doesn't get eroded is 4 to 5 years. But large cap funds end up being a part of one's portfolio till eternity. So for example, in my case, I would be owning large cap funds for several years, almost 12, 13 years. I would always have some portion of my money in large cap funds. So they are an integral part of one's portfolio, but the time frame to make sure that you're not risking your capital is 4 to 5 years.
Right, and just want to point out a side note here that even though for our viewers, that even though we're talking about first-time investors or people who've just started investing, large cap funds, make sense for anybody, whether you're a new investor or whether you're an experienced investor, you've been investing in mutual funds for a while. Large cap funds do find a space in all kinds of investment portfolios. But also, Feroze, let's also look at the kind of returns that one can expect in terms of large cap funds, because even though it is equity, it may not be as high as, say, a mid-cap fund.
The return expectation, Avni, from equities generally, and especially large equities, is about 12 to 13% per annum. Looking at where we stand in the Indian economy and the corporates, the large corporates especially, it wouldn't be very unfair to say that a 12 to 14% expectation over the next 5 years per annum compounded growth is an expectation which you can extrapolate to large cap funds as well. So these are market dependent, of course. So the fund manager tries to beat the market by about a couple of percent. So an expectation of 12 to 14% is a fair expectation, as long as the investor can be patient and not expect a one-way move and stays the course, 12 to 14%.
All right. On that note, that's as far as large cap funds are concerned. Feroze, thank you so much for joining us and putting all of that into perspective. We hope this has helped our viewers understand what large cap funds are and how they fit into one's portfolio. We'll be back with another episode and discuss another category of equity mutual funds. Thanks for watching.